I do these almost every month, and it's really designed so that you leave here knowing more. And it's been a frustrating year to some regards for me because I realize how little you know. And I take responsibility for that. So we're going to try to teach you some more today. Because if you're doing well and you don't know it, you might as well be doing bad, right? So I find that so many people, I had a client just this morning, I was talking to him, he goes, well, John, he goes, I made more account than I made on my money I'm managing than you made for me. And I said, what are you invested in? He named 5 stocks. I said, well, 60% of your portfolio is bonds. Oh. I said, but your stocks did this well. Wow, they did? So it's really important for you to understand this process overall because it's going to help me do a better job for you. You'll be happy and we're all going to benefit to a great extent. What Alex and I are doing is quite unique with your money. It is not common. And one of the reasons it's not common is that if you're a large firm, you cannot do what we do. So we talked a year ago that we're going to look about the types of stocks we're going to buy and how we're going to get out of them. And today we're going to review the last 12 months' performance, but we're also going to show you some other things. Please silence your cell phones if you can. I find that so often people, and I hear this probably every week, it amazes me, they're telling me things they're concerned about with the investments, the market, that make no sense. Doesn't matter at all. Had a guy in just yesterday, been my client for 5 years, and we've done very well. But John, I'm worried. I still want to keep this portfolio real conservative. I said, well, okay, why are you so worried? Well, what if the tax cut doesn't go through, Trump does? What happens then? And what if this doesn't happen? What if this doesn't happen? And I'm saying, well, that's yet to be seen. But we know what's happening right now. So we're going to review today what's going on so you can leave here. I want you to leave here knowing more about really what makes the market go up or down. It's usually not what you're reading about in the news. Yeah, there can be some big event happen over in Egypt that will affect the market for a short period of time, but that's not the fundamental things that really affect us overall. So when we get to certain slides, I'm going to interject more, or Alex and I are going to have a back and forth discussion at this, because I want you to understand more about why and how we're doing. We're having all of the results we've done over the last year audited, and we are, how far up are we as far as percentile, ranking-wise?
Well, I'll show you that.
Okay, we'll show that. I won't take But the thing I really want you to understand is what means a market's healthy, and how do you know? And if the things you're looking at don't give you indication, then why would you want to continue doing that? A large percentage of what you hear that's supposed to be relevant is not relevant. And it's too late. So our model, I spend a lot of money on analysis. We've got Chris Kaufman and Doug up in the Washington State that does an analysis for us. We write a big check for that every quarter. I wouldn't write it if there wasn't a value to having this data. It gives us the ability to make better decisions. So without any further ado, I'm going to have you get started and then I'll chip in when we're at the spot.
Okay, so today the kind of main focus I want to talk about is risk management. The last presentation we talked more about how we buy stocks, like what qualifies us to put them in the portfolio. And today I actually want to speak more and focus more on how we sell stocks or how we stay out of stocks. I think that in a lot of ways is even more important than what we buy certain times of our investment process. Come on in. So recap the last one. In order to beat the market, in order to make more money with the same amount of risk, you have to do something different than just being an index fund. If you just own the S&P 500, you're just going to get that. You're not going to get any better or worse. You're just going to get what it gives you. And so what we're doing here is we focus on a concentrated portfolio of companies that have, the best prospects to go and higher over the market itself. It's important in our process to know the value of what you're buying and to know when to sell it. There's a common sense thing that we're taught, buy low, sell high. Even kids understand this process, but yet it kind of gets lost sometimes and no one really speaks to this point of when to take your profit when you have one. Again, the last presentation we showed how if you're a long-term investor, buy and hold is appropriate for you. There's been no 20-year period in the history of the stock market where if you just held all the way through, you lost a dime. But 20 years is the amount of time you have to hold to realize that. If you're not long-term, which we kind of aren't, we're more medium-term, I would say, we're term-sensitive, the risk management is critical. It is very, very critical part of this process. So to recap, when Chris Kaufman was here, how we buy stocks can be summarized in a very simple analogy. Say you had 2 houses you were going to look at to buy. You only have a limited amount of money, but right now these 2 are listed for $1 million. They are in the same state, they are in the same city, same neighborhood, same rental income, essentially, same bedrooms and bath. They look exactly the same. But for some reason, when you go to buy that house, you get appraised, obviously, by the appraiser. This one only appraises for $760,000. What's going on here? This one appraises for $1.2 million. If you were to buy these houses, which one do you think would go up more in price? Or which one's more valuable, I guess? One on the right? It's that simple what we're doing here when we buy stocks.
And let me interject.
Yeah.
Have you ever seen a stock offered or a mutual fund offered where they tell you what the value of that fund is? They tell you what the price of the fund is, right? But we never stop to consider that. Matter of fact, the price is going up, I want it. The key part to our investment strategy is knowing what we're buying, what the value of it is. The market overall is overvalued by about 15%. We buy nothing that's not undervalued by at least 30%. Just those odds increase our likelihood of making profits dramatically and reduce our risk as well.
So moreover to this concept, what we're going to talk about more today is, say you bought one of these houses and suddenly your neighbor catches fire. Or what if there's an earthquake? This is more what we're going to talk about, the risk management, the insurance behind this purchase. So what is risk management? This word and this concept kind of just gets used so loosely, sometimes I think it can get confusing for people to really understand what it means in a very simple sense. And what it is it's knowing when to sell out, when to not be in the stock market, when to not be in any stocks. And what this does in our model, it reduces our drawdown. It reduces how much our accounts go down overall on an average basis. Now, stocks will go up and down, they fluctuate over time, but if you can reduce your drawdown, you can limit that as best as possible, it will produce better gains without having to take any more risk. So as we kind of go even more core why risk management is so important is it protects your capital, obviously, but really it protects time. It protects lost time. So we have 2 types of risk management here that we employ. One I liken to having an eject handle. So when there's some type of market or economic risk that is very clear, is going to take a lot of time to come to fruition, we can essentially pull the eject handle and get completely out of the stock market basically in one day. So this is designed to help us not have to endure any stock market crashes or recessionary periods. It's a sort of a longer term type of modeling technique. It's not going to help us predict or sidestep any one-day event. For example, Brexit, that caused a big flurry in the market and it was kind of one-day thing, but it was pretty volatile. Right now, the big thing that people are talking about is the French election. To me, I don't really see how it's going to change anything for America, but I guess it can affect the euro. So we have an eject handle. But the other part of risk management we have is what I liken to a seatbelt. In each stock that we buy, we have risk management, meaning we know where we're going to get out of it if something happens within that stock holding. For example, earnings seasons right now, we made quite a few trades the last couple weeks because initially we bought stocks we thought were undervalued. The model sees these as undervalued stocks. And some new piece of information comes down the pipeline. Sometimes it's not always bad. For example, we owned a company called MedX, which has a kind of a conglomerate with prenatal facilities. And they decided to go out and borrow a bunch of money to buy their next biggest competitor. So if you think about that, it's actually a good thing for MedX, but when you take a lot of debt to do that, it makes the shares less valuable. And so the shares fell and we got out, before it went down even further. That is that single stock seatbelt safety. So this is key thing to understand. Wall Street as a whole does not operate like this. They preach, even Warren Buffett comes on the news 60 Minutes and says, buy and hold the S&P 500 forever. And I don't know how he gets away with that, because it's just irresponsible in my view.
Well, let me add, I had, a few months ago, I had an investment banker come calling me from JP Morgan Chase. And he was trying to get me to use some of their investment tools and so forth. And I said, that's not really the way we invest. I said, we don't take that kind of risk. And I explained to him, I took him a chart and showed him how every position we buy it, we put a sell order in at bottom and low and the pricing and all like that. And he goes, wow. He goes, Johnny goes, yeah, that would make you a lot of money, but we can't do that. And I knew why I couldn't do that. They've got $8 billion they manage. So they can't unload that many shares in a day's time. And he wasn't being contrite. He just says, we can't do that. And that's our advantage. We can do that. So most firms around the country today, you don't have firms doing this kind of class with their clients. Typically, if firms have their clients in, they have them in to sell them something. They come in for a sales presentation. And they don't really educate that much. And I think part of the reason is they're not doing that much. If I just go buy a portfolio for you and diversify it, say I bought a little bit of everything, and I hold it, what is there to teach? So this is, you're going to see why Alex and I are, and you're going to see why this benefits you so much. This strategy to be more discerning, not just of what we buy, but when we sell and so forth.
Right, exactly. So why is this important to have risk management so critical actually right now? Even though the market's going up, and I'll show more slides on why that's a really good thing right now, it's important to understand where we are, just statistically. Right now we are in the second longest bull market as qualified by a lot of different ways in history. So there was only one other time that we know of, or that we have data of obviously, that the stock market went up consistently without a severe bear market. And that was the 99 internet bubble. So right now we're the blue line. This is basically timeline until a bear market happens. So we're getting close to the record. And it's either a good or a bad thing, but cycles in economics are natural, and they have a natural fluctuation. We just can't expand forever. We can't have a recession forever. So it's just important to understand where we are. And right now things are good, but there will be a time somewhere in the future where we need to get out of the stock market, and we need to basically stay safe in risk-free assets.
Well, that was a client yesterday. His concern was, John, he goes, other than you have what if Trump's tax package doesn't go through, and we're at all-time highs now. It's time to get out. And that's just a statement that lacks a lot of knowledge. There's going to be a time to get out, and we will know when it's time to get out. But we're going to do the math before we do that. The math will precede the activity.
Right. I think, what happens in financial news is they take some idea that might have a scientific study behind it, and they simplify it, so small that they can print it in the newspaper, and a lot of the meat is lost. So people might hear this on the radio, or Jim Cramer or whatever, all-time high is a bad thing. I mean, I could almost pull statistics that show it's quite the opposite. That's exactly when you want to be in the stock market, when it's going up, right, making new all-time highs. So there's kind of an adage that I like, that I think is very accurate, is that bull markets don't end in old age specifically. They end with some type of extreme excess. The housing bubble, the internet bubble. These are things that are the catalyst to making these excesses have to come back. And right now, there's just really not a very clear excess that we can identify. There are some that I think are important to really keep our finger on. Debt, for example, is kind of the biggest one. The subprime auto lending issue is what I think is maybe the catalyst. But again, auto lending isn't like home lending. It's a smaller degree, And it doesn't really ring across the entirety of the economy the way that the housing bubble did. What I actually think is we might be at the cusp of another expansion that could lead to a bubble type event. I'll talk about the repatriation, what that really means in hard numbers, and some things I think are really important to realize about China and Eurasia. So if you did not have risk management and you're a buy and hold investor and we're nearing the end or you're nearing the peak of bull market duration, what can happen? Let's just think about if you don't have risk management. The average decline is 34% in a bear market. So you'll lose 34% of your account if you just buy and hold through that. Sometimes it's not as severe, sometimes it's devastating, like in 1929, but on average, we don't want to lose that much money ever in our portfolios. That's why I think buy and hold is a fallacy and why you need risk management. You need to know when to get out, right? So here's just a basic arithmetic about how that works. Say you were buy and hold and you bought the stock market today, and we just started the bear market tomorrow, and went down 20%. Well, in buy and hold terms, how long would it take for you to just sit there and get back to even? Well, the stock market makes on average 7% over history, right? So you'd have to wait 4 years just to get back to your original investment if you have no risk management. Well, say the stock market rebounds really quickly and does a little bit better than average. It still takes you 3 years to get back to even. And what if you did probably the worst thing is that you get scared, you make an emotional decision, and you move to bonds right at the bottom? Well, you're only going to make like 2 or 3%, so that's going to take a decade to get back even. So these are the outcomes of not having risk management in the forefront.
And it affects different people differently. If it's your 25 or 30-year-old son or daughter, it's not going to really matter. But if you're 70 years old and you're living off income, it's going to really matter. And the biggest thing we do for anybody in this room is your distribution order. So you're probably going to get beat up by the market, take it out the wrong way, and many people get scared and go into bonds or cash, and they never recover. So it's long term is a lot longer once you retire, and when you take distribution, it's also a lot longer. And I think you really need to be aware of that before you go invest your money.
So some people have huge amounts of company stock, and I like to just pick on Exxon and Honeywell because those are the biggest legacy positions we have here at JCN. And I just wanted to show this, even though it's kind of hard to make sense of it, what could it be like if you just kept all your money in that company stock? Again, Exxon and Honeywell are huge conglomerates that are not going away anytime soon. But in Exxon, which is the red line here, you lost 30% in 2003, and it went down about 40% in 2009, 2011. So obviously it came back, and it pays a really hefty dividend, but you weren't without risk. You had significant losses there. Honeywell, on the other example, took a much bigger beating than even the stock market. This is the S&P 500, by the way, the blue. And you can see it's these really nasty bear markets where just the kitchen sink gets thrown out. You know what I mean? People just don't care about how these companies are, and they just sell because they're selling. So our strategy, and this is from our model, looking backwards in history as we built this, is this top blue line here, top blue shaded area. So you can see it's a fraction. We're not going to have no losses. It's impossible to do that. It's impossible to have winning trades every single day, every single week. We will have some periods of drawdown, and some periods of drawdown will be the same as the market, like what happened last year. It'll be about the same. But it's these big, nasty bear markets that these models are really designed to help us not have to endure.
Everybody can understand that chart? Show of hands.
It's just drawdown, how much you've lost from whatever the highs went. So let's talk more about the eject handle. I don't want you to read this whole thing, but as an economist, I want to just show you what the factors are that go into building an economic model. There's huge amounts of factors. And the idea behind these is we don't want to have to rely on one thing to make a decision. If auto sales are bad, but industrial production is good. If GDP is bad, but the labor market's good. How do you make sense of all this? And to be honest, the human brain is really incapable of doing that on its own. You have to use machine learning, computerized learning models. And this can be likened to what you're seeing with driverless cars. Cars they don't really get taught how to drive without a person. They are trained because they experience this a million times. And so when they get to a corner of the road, you know, it's not that they were born to know how to turn left or right. They've already done it 10,000 times, so they know how to go left or right. They know how to stop. So by putting in all these factors, we're not leaving anything out. If there's something that happens in, you know, ISM, or if there's something that happens in the loan market, it'll get picked up by our model, and we won't be, you know, sitting here saying, "Oh, I wish we could have saw that coming." You know what I mean? It's all in there. I just want to pull a few of the key ones, just simple stuff. If you just look at industrial production, literally making stuff, America making things, and you were only invested when we were making more things than last year, which is this line right here. Well, I just put an S&P 500 graph on being invested when we're making things versus when we're not making more things. And you can see the blue line is just being in the market, no different than the white line as far as the investment, but only being in when the economy is healthy. It's kind of a no-brainer, right? But the other thing to point out is these recessions, you know, we don't know how long they're going to last sometimes. Sometimes they can be more severe, but they can be a few years. We can be out for a few years. And I want you guys to know that, and we want to reiterate that, communicate that, because when this happens next time, you know, we don't want there to be any guessing on what's going to happen next. We're just going to be out when the market's not.
And we won't be out. Being out like this probably won't happen more than once every 5 years or so, all out.
Right, yeah.
It's not a real regular thing that happens.
Exactly. It doesn't happen every year. So the big thing that was happening last year was earnings. We kept saying in our newsletter and meetings, the market's not healthy. I mean, it wasn't. This is the data. The market was losing money. Their profits were going down. So at some point, this got so severe in late 2015 that we were in cash, right? We had no stocks. That was basically at this point. And we didn't know that the market was going to rebound. We don't forecast that. We just know when it gets really bad, we don't want to be in it anymore. Fortunate for us, it started to go back up. The numbers came in positive. We got more fully invested as the year went on. But we're going to have these periods in time where the data does not match the stock market. It's going to say it's unhealthy, or it's going to say it's healthy, and stocks could be going the opposite way. That's going to be important for us to acknowledge and communicate. Because you can either have it where stocks are going down and we're buying them because we see the data's good, and you go, why are you buying when stocks are going down? Or stocks are going up and we're not in it. Why are you buying when stocks are going up? We need to have fact, proven data before we do this. That's the key to risk management.
Well, and last year, part of the time we were in cash, the market was going up. And I'd have clients come in and say, John, why aren't we investing? Market's going up. So I had a dissertation on why we're not in. So it's that mentality, you have to make money every hour of every day will never make you a dollar. We have to have a little bit longer time explaining that, but there will be times when we're not as invested. We pull back a little bit here recently, not a lot, 2 or 3%. But all these things come together to get us to a much better conclusion.
Right.
Those dates on the bottom
Here, I'll go back.
are from when to when.
So that's a forecast.
That's just a forecast.
This is forecast here.
Estimate.
I don't build this. This comes from Morgan Stanley.
But this is last year, 2012.
Yeah, this is just to show
That's
what
from
happened.
16 to March 16th of this year.
Yeah.
I'll show the most recent one in a future slide, but it's looking good, and I'll kind of show why.
Yeah, earnings are hot.
So this, again, not industrial production, but this is the outcome from industrial production. This is earnings. You can see, just stripping it out from our model, when earnings are going down, we don't want to be in the market. Now, there's going to be some stocks that go up, and we can find those from time to time. For example, when the market's crashing, gold stocks sometimes do really well, or Procter & Gamble, or some of these, General Mills.
And this is from 2000 to 2002, another bear market, and this is 2008 and 9.
Right, so this was happening basically when I moved here. So it was kind of a rough time to start our model because it was, not saying go fully in the market. We've since had a nice uptick here. I'll show you, zoom in on that. But things are looking better. Things are looking better going forward. So this is our model. This is something that we generate ourselves. I call it just a composite. It's all those factors that you looked at, and we basically have a number on what the economy is and is doing every week. It gets updated. So you can see the economy is the black line. It mirrors the stock market because it's kind of the same thing, but it's much smoother. It's just this kind of smoother organism that doesn't have big fluctuations. It's the stock market that gets kind of wacky. And this is important to look at because in this instance, 2000, the economy and the stock market basically turned down at the same time. So in that instance, this model wouldn't have got out, until after it started going down. This is a good example of where the economy started to go down in 2007, the black, and the stock market kept going up. And went up for a year. So those are the things we're going to be able to identify very clearly, and we won't second guess that because it's just data, easy to understand that the economy drives the stock market to the biggest degree, and if you just ignore it, it's going to burn you on the next time around.
Alex, when you say the economy, the black line, what are you talking about? What economy? What?
Earnings, jobless claims, payroll, industrial production, personal income, manufacturing sales, GDP, initial claims, everything. Everything. There's so much data now, it's almost too much. But there are some just key ones that are very simple, like I said, industrial production. Are we making more things, right? That's really what drives all this. So that's what we're able to model. Basically, the bottom line is we have a plan to get out, and we have a plan to stay out until it's better to be in.
Again, this is 2001 and 2.
Yeah.
This is 2007, 8, and 9.
Yeah, there's no guarantee it's going to be that long. It might be shallow, it might not be there at all, but yeah.
Alex, when you get out, what do you get into?
Treasury bonds, to some degree, but cash is king.
Cash being what, money market or?
Yeah, it's a money market. I mean, when you guys look at your accounts that says cash, it's not actually in cash. It's in a thing that TD Ameritrade is equivalent to cash, but it says liquid. You can buy and sell at any time. And the main reason we don't want to go all in treasury bonds is because what if treasury bonds are crashing at that point? In that time, we kind of just want to wait for stock prices to go down. We want to go buy great companies again at pennies on the dollar and ride them all the way back up.
This is the most sophisticated terminology, but what I like to think of this, a pig gets fat and a hog gets slaughtered.
Yeah. So what does this require? For us, it requires the right data, which we have. It requires the right models, which we definitely have. And Chris Kaufman is going to be here, I think, November again. And if anybody missed that one, I would highly recommend coming because he's really the physics genius behind a lot of this stuff, and we just implement it with discipline. It's going to require some patience, making money and being out at certain times. And then for us, it's important to communicate this. It's really important for you guys to understand why we're doing what we're doing and know that there's evidence. There's no, I think this, I think that. This is happening, we don't want to be in, or this is happening, we want to be aggressive.
Now this came into being because when we talked to Chris and Alex a couple of years ago about doing this, there was a discussion about using inverse funds when we're in cash. So in other words, the market's going down, we go into an inverse fund, which gives us the opposite market, we'd all make a bunch of money. And that's true if it happens that way. But there's no getting around the fact that's a riskier way to invest your money. If somebody tells you using leverage is less risky, that's just not true. And so I decided to be, I'd rather be a pig than a hog with it. So we're going to spend the time and discipline and forthrightness to get the most we can out of the lemon without trying to cheat. So we go to cash. We don't go to an inverse fund. No doubt that could make you more money, but I can tell you it would cause you potentially have more risk and problems, and nobody wants that.
Yeah, exactly. So that's the eject handle. hopefully you guys kind of get that. That doesn't happen all that often. What happens more often that you see in some of the trading is what I call the seatbelt. And I just pulled a few examples from recent investments we've made, and John's going to kind of walk you through what that kind of looks like.
So we have this chart here you're real familiar with, and I thought some of you aren't able to read these charts as well as Alex and I can read them, and I don't have a great proclivity towards as well. So we have something else to show you that I want you to let me know on your comment card whether this is a benefit to you. So there's so much fear with investing because you think, well, I could lose it all. Wouldn't you agree that makes it scary? But if you said, you know what, the most you can lose is 20%, who says that's better? That's better, right? So what we do here takes more time. We have to be very, very diligent to have this. This isn't a set it and forget it type of strategy. So this was Greenbrier. We bought Greenbrier for $35.13. Now we had an appraised price on it, which isn't shown here.
Yeah, it was like $50.
But we knew it was worth $50, so we bought it on sale. But we put a sell order or a stop loss in at $27.66. What that meant was, hey, if it just crashed to the floor, you keep $27.66. Does that make you more comfortable? Okay. So then this Greenbrier dropped to 30. We kept our stop loss right where it was at $27.66. But then Greenbrier went up in value, started to get more what it's worth. It was a 40. And look what we did. We raised our stop loss from $27.66 to $34. So now if it goes away, you keep $34. Is that better? Yes, better. So then it goes up to 45, and we walk the stop loss up to 40. So now if it goes down, we at least keep 40. Our price target at 47.88 was hit. We hit that at 47.88. We sold it, and it's dropped 5.55% since we sold it. That's the way that's done. Not every time is it going to drop after we sell it, but that was one example. I'm going to let you do the chart because you.
Yeah, it's just a good example because it's one that the model just got it perfect. You know, it went to our fair value target. You know, we're not sitting here thinking, oh, it's going to keep going up. We know where we're going to sell it when it gets there. Mechanically sell it, and then there you go.
I train with 500 different men and women at Ed Slott's group, and I don't see 500 at a time. There's maybe 150 there at a meeting, but I can tell you, if you sit down at a table, people are managing money, and you say, if you own this position, when would you sell it? And there's 15 people there, how many different answers will you get? And nobody knows, right? So I think a mathematical application just takes your emotion out of it.
Right. So here's just
Period of time that
Every stock at 35% profit?
No.
it's more adaptive than that, but the math behind it is if we're risking 20% pretty much on average every time, you want to at least make 35. So there's kind of a we want to be the opposite of Vegas, right? You don't want to lose more than make.
But I think we bought Apple for about $100 a share, wasn't it?
Right.
And it was valued at $300 a share. So if it hits its valuation, we'll make 300% on that.
Right. So again, not all companies are valued the same. There's times in history where there's nothing to buy, and we'll just hide in the S&P 500.
We had some time last summer. We had trouble finding positions to buy while the market's going up.
Right. So here's another example.
Penske Auto Group. So
I see those trucks all over the place. You guys see them? Yeah.
So same thing happened here. We bought it in your portfolio for $44.56. We put a stop loss in at 38. Well, it goes up to 45, and we bring our stop loss up to 40. Well, it goes up to 50. Now we say, okay, we're going to at least get 41 out of it. So we would still lose, right? If it dropped from 50 to nothing, but we keep 41. And then it goes up to it goes to 43.50. It drops. Our stop loss remains right where it is. It rebounds up to 55. We sell it for a profit, make 35%. And Penske has dropped 20% since we sold it, because it got to its appraised value is what it amounted to. Every stock we buy, we have it appraised. That's why I pay Chris Kaufman and Doug for, the gentleman that's going to speak in November. That's what they do. They have the software that appraises any stock in the universe I can get. And so we sold it. We made a 35% profit. It's dropped 20%. But the average person that bought it, that didn't happen with them. You have to know two things: when to buy and when to sell.
It's just the graphical form of how it looks when it's going on the computer. Apple, for example, is an example of a stock where the value that we appraise it for is really high, so we intend to hold it much longer. So we give it a little bit more leeway, we give it a little more risk. But the whole point of that is we're going to hold it for more gain. So it's kind of got a bigger net. So
And we appraise these every single week. So because the value is priced at 300 this week, next week it could be priced at something north or south there. We're going to move that around to get to that point. But the same thing happened. We bought it at 106.82. Stop loss is 87. Stop loss is when you saw it at the bottom when it was going down. It went up to 112. We kept our stop loss the same spot everywhere until it got to 118. And now the stop loss is at 100. So we paid 106. We would still lose $6 or 6%. It's currently trading at 141, and our stop loss is 125. So if it goes to the toilet now, we get out with a gain. And you have 30 positions that we do this with on an ongoing basis.
You do it on a weekly basis, your stop loss?
Well, stop loss is always there, but it's revalued every week. The stock's valued in the stop loss once a week.
And these examples, over what time period roughly did this?
these have been, the Apple we've owned for a while. The whole time, we want to try to hold it as long as possible. But if it gets there, we're out. If it takes long, there's a couple of positions that we bought them and they literally didn't go anywhere. We went sideways, up, down.
I think all the ones we showed so far, though, were held for 6 months or less.
Yeah, those have gone up to 6 months. But some like this, we've owned it over a year. We have a few more that we've owned it a pretty long time, so they're in the long-term gain area. That's a good question.
Is there a cost to us or to you when you keep changing those stop losses?
No.
No.
It's just a,
Good question.
It's just a price that the model gives us. It's just our duty to sell if it gets there. There's no order
put
generated.
that into TD Ameritrade, there's no cost to change any of it.
I pay for all that, but what I did is, I'm a big personal control, and so I had an option when I bought with TD Ameritrade. I could pay them per trade, which was less, or I could pay them a certain percentage, which was more, but it was flat. And I like going with what I knew, so I paid a certain percentage. If we have to trade it every day or once a year, it costs me the same difference. It doesn't come back to you at all. It's my cost there. So it's a good question, though, because the fee you pay me is not just in this office. We take that, we pay TD with it, we pay Parallax for it, but it's all done for the same. I wouldn't do this if I could go somewhere else and buy it without having to. If I could just go buy this into a fund, I'd go buy it. I would save probably $200,000 a year by buying it in a fund, but I just can't get it. And so a lot of my business, the business I have today, most of y'all are referrals. So I can't, I'm just not going to have Don refer his neighbor to me and then him have to apologize to the neighbor for the job I did. So this is really all in-house, and it's made just for me, or you.
So here's his Apple. You can see when we bought it, it went down. That's the thing. We're not going to get the blow. We're not going to get when it goes straight up. It's going to fluctuate. That's not. We have no way of knowing that. It's unpredictable. But we know Apple is just a behemoth company with billions of dollars of cash, so the value is just obviously much higher.
And it does seem like when we buy them, they go down. It does
Most of
seem
the
like.
time, the best ones probably do.
You look at it 2 weeks later, man, that was a humdinger. But they've done very well.
So, okay, well that's a seatbelt. Now, before we talk about the performance of where we did from April to April, I wanted to just build some more knowledge about expectations. And I feel like sometimes people come into meetings and they look at how much they made and they're kind of not dissatisfied, but they just don't know if that's good or bad. So it's important to understand what to expect when you're just riding along here with us. So I just pulled the numbers for what's our Model 4 and our Model 3, and I just simulated that over all the way to 1930s. And you can see in a Model 4, there's certain decades, again this is a rolling 5-year period, so it's kind of like a medium-term hold that we're focusing on. In certain decades, a Model 4 made no money. In the 30s, 75% stock and 25% bonds, scratched. You basically had no more money than you did 10 years. In certain decades, it went up a lot, double digits. And it's not 100% stock, In the 80s, if you're bonds and stocks, you made really good money there. Not being all invested, right? But what's the average? The average is around 8.5, 8.25. That's over 100 years, right? But the key thing to understand, and keep this in as perspective, is that 50 of the last 88 years, all that we have data for, 56% of all the time, a Model 3 made less than 4% on an annual basis, on a one-year basis. So when you look at your statement or you look at your account and you didn't make all that much money for maybe 1 year or the next, you got to realize that the gains are made in very short spurts. The big gains are all made in short periods of time. The bull markets just really rip up, and that's where all the hay is made. The rest of the time, it's just sitting there getting interest. So it's not make 8% every year. It's maybe not make 8% for a couple years. It could be make 0 for 3 years and then make 50 1 year. That's really the reality of how the investment procedure works. So we need to know that, when you guys come into meetings and you look at statements and, so a 3-month period is really irrelevant to us because it just doesn't show, what should happen.
But it's important to understand that because that can cause a person's angst and fear to grow. Right. I made 3% this year, made 3% last year, and they're not looking at what happened in the marketplace, and so I'm going to get out. About the time they get out, you have a year where the market goes up, 30%, and now they've, the game they should have had, they don't have. Again, for each one of y'all, the thing I think is least appreciated that we do is the single most important thing I do here. And I think you'll attest to this. How important is distribution order?
I mean, it can make or break the whole plan.
It is the difference maker, bar none. Doesn't get much press, but we have that in place to get us through those lean years. And we're going to see how we do with this. But I think that having your expectations accurate, fair, are really important to how well you're going to be able to manage your volatility.
I mean, the other side of that too, we're not going for 50% returns. We're not really swinging for the fences. This is actually a fairly conservative modeling style. Before I worked here, I worked for hedge funds, and our goal is to make as much money as possible, with not really looking at risk. So we're really swinging for the fence every time. This is a totally different model, yet using the same technology.
But that was a conscious decision of mine when I had this model built out, because I didn't want to take people that were 60, 65, 70, 75 years of age and have them invest with the same risk tolerance as somebody that's 20, 25, or 30 years of age. I didn't want the risk. I wanted to get more money by being more efficient, and that's what we've done.
Okay, so before we show what our composite number was last year, let's first look at how we measure ourselves. First thing we do is we measure ourselves against our peer group, which S&P 500 Standard & Poor's puts out this report every year in April. It's called the SPIVA report. It's at this link. I highly recommend taking a look at it. If you want to look at it, it's got a lot of information that I think is pretty telling. But for last year, and it takes them a while to get it out, they usually get it out in April. Last year, 2016, 66% of all large cap managers, which is most of them, 89% of mid cap managers, and 85% of small cap managers underperformed the market. They did not make as much as just being in the S&P 500. So all those people got paid to make less money. Okay, so that tells you at scale, it's really difficult to do. And I don't know what they do to keep that money, but it just seems ridiculous at this point. So we're considered multi-cap. We kind of we're not just S&P 500, not just in mid-cap, kind of all over the place. So our number is the multi-cap number, 75% underperformed. So you can see for us, the 25 percentile is a little bit better. The multi-cap section is a little bit better. Over a long market cycle, these big, huge funds, it's almost impossible for them to beat the S&P. This is the 10-year number. Basically, only 10% of all of them that they surveyed, just thousands of them, only 10% essentially beat the S&P over a 10-year period. It could be from a lot of reasons. It could be because the ones left are the only ones that are around. But I just want you guys to know it's really difficult, obviously on a 10-year period basis, but on a 1-year period basis to actually beat the market unless you're taking significant amounts of risk. So this is our composite number. This is what we do, we take every account and we have to take the median. So some accounts made a couple percent more, some less. If you had huge withdrawals because of the flooding, you know, your number could be different. But when we build this out for advertising, it has to be audited by a third party, and this is basically the number that they're going to verify happened last year. So the S&P made 17.34, and our model was just a speck over 21. So most accounts are really close to that. You know, we acknowledge that some of them, depending upon the cash flows or whatnot, can be slightly different. But when we report, we have to report the median. We can't report the best one, we can't report the worst one, we have to report the median.
So we got, well, for what the market did, whatever the market did with the stock portion, we produced 21% more net of fees. And I'm really curious, we're being audited right now, I'm curious to find out how this is going to rank nationwide, but I think we're, from the ones
Well, good start, that's a good thing, you know? You started off, I know it was kind of, you know, you gotta see proof in the pudding, so to speak, so at least from our end, the model did what was expected. It actually could potentially do better. You know, what we expect over a full cycle in a really good year is to be up 6, maybe even 10% above it. Now, there's no way to know if that's going to happen, but in our modeling and a lot of simulations, it's, you know, something that...
And when you pull your reports, look at the persistent value. That's the stock strategy. So you're going to have persistent value, and there's going to be a benchmark against it, which is the S&P. There's going to be a precious metal benchmark, and there's going to be a bond benchmark. This is the persistent value strategy. And so when we give you a report here at the office, it shows that. If you go pull it online, it's going to show you the very same thing.
Right, we strip out the bonds because some people have more bonds, some people have less, and that's not really something we're like actively managing. We're not using a model to make our bonds make any more money. We're sitting in a very risk-free aggregate that the whole point of the bond is just to not move. We want it to be very stable and just provide some level of income.
And as I said in some of the meetings recently, that I think if you've been in a Model 3 and you're really, really comfortable, you might want to move to a Model 4. Think about it, because being that we've gone with a shorter duration bond, we get less of a yield for that. So it's not going to be as attractive as it would have been when bonds were just tearing it up as much. And if interest rates go up, bonds go down. So in some ways, bonds are riskier now. So as you've come in, for most of you, I've recommended looking at, if you're in a Model 3, looking at a Model 4.
Yeah.
So what you're saying is you're in the 10% that's beating the market since April.
Yeah.
For last year, we're actually in the 25th percent, because we're multi-cap. Remember, we're multi-cap. We're not large cap. So for last year,
Okay, you're in the
we're in
25.
multi-cap. We're in the 25 percentile, which,
And you'll find out.
you know, last year was good for a lot of managers that are all cap, because a lot of little stocks went up pretty good. As you remember last year when I kind of showed this, the only stocks that did well were the big, huge Facebook, Amazon, Netflix, Googles. So it was a better year than average for people in our category.
And you're using the April because that's when you really started using your model.
That's when we started using it.
Yeah, I mean, 1 year is the way to do it. So to just summarize before I go on to like an outlook, will we beat the S&P every year? No. I want to make sure you guys expect that there will be a year we'll be under it.
Why?
And I'll go into that.
He's doing a bad job those years.
The reason being is because we're not indexing, so when we're doing something different, you can actually get a pretty big different result. The years we will do much, much better are when the market completely crashes, because we might have a small loss and the market will go down 50% and we won't be in that portion. Or in multi-year, really long bull markets, we're going to be so concentrated in our 30 to 25 stocks, it's just we're going to get more juice out of the lemon in those periods. The periods where we're going to struggle, just so we know in the future, and I'm not in a big way, but you know, maybe a couple points up or down above it, is these flat or down years where not all stocks are kind of working together, and you know, I think it's any manager would be struggling.
Because our strategy has a 1.2 beta in it, so we have a little more. When the market goes up, we're going to go up more. Right. So today, when the market was up 70 basis points, we were up 105. But when the market goes down, we're going to go down worse than the market. But there's more up days than bad days. And then we also have the two seatbelt and ejector we talk about to minimize our loss.
Right. So, you know, you can't get perfect everything. So that's going to be the times that we're out. So a little bit of outlook, you know, this is where if you had any questions on that previous section, feel free to ask now, or I'm just going to kind of talk about what I think is going to be going on forward. And the reason I do these outlooks is because there's so much, I guess they call it fake news now, that it's really important to me that you guys kind of see what we're seeing and don't have to trust what's on the damn television. So when we look at our statements and performance during the year, you know, one thing is it's seasonal, and this is something I talk about sometimes in meetings. The gains are not all in the whole year. The gains of the market, if you pull them from history, they're only in a few months. You know, the biggest gains are March, April, and October through January. This middle period, the summer doldrums, you probably heard it, sell in May and go away. It's a very real thing, and you just got to be aware of that. Right now we're in the April period, so we're getting some of that nice little move. Earnings. So
Let me stop for a second.
Okay.
What he's talking about right now, all this information is what tells you what's going on in the market, whether an investor or not.
Right.
Not the political upheaval, not the taxes. These are things that have some granularity about
Yeah,
them.
this drives stock prices, not the news, not whatever. This is what makes stock prices go up, provably by many, many people. Earnings, profits, essentially, and growth, right? So this is what just got reported. This isn't what's happening. This was Q1. Earnings as a whole for the S&P, which, you know, is easy to get, was up 10%. So that's why the stock market went up. The value of the companies is much higher. And what's more important is looking at what types of companies made money. 2 years ago, the only companies that made money were the big Apple, Microsoft, just behemoth, just huge companies. Well, right now, the smaller companies are making bigger gains. So the parts of the economy that were struggling before are catching up, and that's a good sign. It usually means that it lasts into the future much longer.
That's
Green is like the smaller companies, and the blue is the bigger companies. So the blue companies are actually making a little bit less than what the smaller companies make, which is good. So what about the whole world? I have the ability to pull, you know, every stock on the planet in our database and not just look at America. And what happens when China, the BRICS, Europe, a lot of these other countries, when they start to move in sync and get in gear, that's when you get some really big potential lasting moves. And that's what we're seeing here. This going flat means like everything else, Europe is just unprofitable, not making money. The fact that it's going up, that's a good sign that, you know, there's going to be more trade. If China starts making more money, they want to, you know, trade with other people. If we start making more money, we want to buy things from them. So it's this kickoff, basically a catalyst. So that's a really positive thing, and it's indisputable. So it means it's a healthy market. The only kind of political thing I really want to emphasize, and I talked about this last time, this could be major, major big league changes. It's the cash repatriation. There's a survey that just came out by ITEP. You could go check this out later yourself, but they just did a survey last month on how much cash, not bonds, cash, sitting offshore, waiting to come back to America at a lower tax rate. It's estimated to be $2.6 trillion. Why is this significant? Well, just to compare how big that is, the biggest country in Europe is Germany as far as GDP, and their entire GDP for 1 year is $3.8 trillion. So we have more cash. We have basically enough cash to buy every product and service that they make, almost, just waiting to come back to America. So the news, I don't understand. You know, I'm a trained economist. People don't understand how big this can potentially be. If it comes home, what the first thing it has to do is pay taxes. So the governments all over America, the coffers get swelled full of more money than they even want to spend. They're the biggest spendthrifts on the planet. No, they will. You're right. So they want it here as much as we want it here. They're not going to fight it. They want it bad. You know, if Microsoft, who has $180 billion in cash, is going to pay whatever tax they're going to pay on that, that's just free money for all these government entities. So, but what are the companies? What do they get to do when they get that here? They only really have a few choices. They can hoard it, which is what they're doing now, and I doubt they do that. They usually start doing a couple things first. They buy back their own shares. They basically reduce the amount of shares out there. They'll increase the dividend or start paying a dividend, which makes the shares go up. They'll reduce debt, which a lot of them kind of have. Only after those three things first do they start to invest in new capital, a new factory, new this, new that. Chances are they're not going to invest in jobs. They're going to invest in robots. So just be aware, the next companies that build out.
Is the
CapEx.
recreation in the list, already in that list of factors that you showed us earlier that go into your...
No, this is something we don't model, but I'm foreseeing this. Instantly what happens is all these companies become more valuable because now they have more cash, they have less shares, they pay more dividends. That's what I'm kind of trying to say right now is, there could be a huge effect on the stock prices. For example, Apple has so much money, they could basically buy Disney. Just straight cash. They don't even need to invent their own things. Yeah.
Alex, when do you expect that to happen, that money to come back from offshore?
I was just watching the thing with the new Treasury guy, and they're saying August is the first time they're going to look at it. They want to get it right because they just kind of fumbled the health thing. Right. I bet they really try to get it right. And even if it comes over in a small way, it's still free money. It's still going to have some effect.
So what tax levels are going to drive this?
I'm not a tax expert, but it's much lower than what they're paying now. So, for example, I think some of the, I don't know, he knows better than I do, but
Well, the talk is trying to get down to 15%.
yeah.
So they
They're
do.
going to figure out ways to even pay less too. You know what I mean? They're going to figure out ways to lose money on paper, but somehow get it here.
Because these companies would like to have their money back as well. I just couldn't afford it at the other rate. So I think you have two parties pushing toward the same
Yeah,
end.
there's no one going to fight this at all, and so that's why I kind of think it's a major thing. So where is this going to go? Now we don't point the model in any given direction. It figures its own way through the stock market. But if you just look at the industries that are growing right now, chances are that's what's going to keep getting better. The top two, which you see a lot of those stocks come into the portfolio more often now, is healthcare and technology. Healthcare and technology. They're actually kind of the same thing at this point because a lot of the technology being invented is really for extending life in some respect. Now, these other companies, they're just such mature industries, it's just that's why they're not growing. Doesn't mean they're not going to benefit. But when the model will look for the whole, what to put in a portfolio, it doesn't want a company that's just going to sit there and go nowhere. We want to buy companies that are going up. So it's probably going to be in that healthcare technology we're going to be somewhat, more invested in. We have no way of knowing how much, but that's what's going on. And the theme that I want you guys to kind of keep an eye out for, this is on my radar because I read about it all the time, is this Internet of Things revolution. Now, you guys all remember the Jetsons cartoon and some of these science fiction movies that were so popular years ago? Well, that's really close to happening, in my view. I don't think flying cars, first self-driving cars. But for example, we got smart locks here at the office where I don't need a key, I just literally come and swipe my phone, fingerprint. That stuff, it seems like, it's not going to move the needle a lot, but it's going to revolutionize life yet again, I think, in huge ways. Smart appliances, you're going to have things where It automatically turns off all your lights and your air conditioner when you leave, and when it sees you're coming home and you're within 30 minutes of being home, it turns everything back on. I mean, it's really pushing towards more energy efficiency in a lot of ways, so that's going to save money. Smart metering, smart clothes, there's all this stuff that Apple's working on the watch to monitor your blood sugar levels. I mean, it's really amazing some of the things that are going to be coming down the line here. And all this is driven by technology.
They canceled the Energy Stars program.
I know, so, I'm not really clear on which directions it's going to go, but we'll see it in the data. Certain companies will just really start to go, and the earnings will be huge, and we'll be there. We'll be there to get it. So how big can this new theme potentially be? Now, no one has no way of knowing, but they're estimating right now just this concept of like all your devices and these new technologies, smart cars, for example, it's estimated to add another $6 trillion to the economy. So it's sometimes hard to visualize how big that is, but it's like magnitudes more going on. And there's only going to be, there's going to be fewer than not companies that are really involved. So,
And we won't be the first to buy the next hot stock.
yeah, we're not really into this.
Because our strategy is we have to have a stock that's 30% or more undervalued persistently for 3 years. So if you're brand new, you know we're going to have that one.
You're not buying marijuana stuff.
Yeah, we don't.
That's a heady proposition.
Nothing illegal. So that's it. I want to just leave with one other slide so that you can kind of feel a little bit better about not having to pay attention to the news, because there's just some very easy things to bank on in the future. Right now there's 7.4 billion people on Earth. This is a guess done by the World Bank. There's going to be 9.9 billion in 2050, so not that far away. Not too many years away. That's 24% more human beings on Earth buying cars, buying iPhones, going to school, getting health care, buying groceries, using energy. That's what drives your investments over the long term. So I hate when I turn on TV and I see this guy going, the next market crash is happening next year. Put it all in gold. They're selling something nasty. So.
Well, please take time to give me your comments on your evaluation form. I'll read every one of those today. So it gives me insight as to what we need to do more of, or maybe what we didn't do well enough. So fill those out to get your comments down as well as possible. Give them to Leanne. I'm going to read them between now and 7 o'clock tonight. And as you come in for your quarterly meetings, I'll show you something we didn't show you tonight. That's just all positions we have and what the relative cost is and the profit. And to show you where your stop losses are. Because if we buy a stock and we're 20% stop loss down, you don't have that 3 months in your portfolio because your other positions have come up. So I really want you to get a feel for how much we've dampened the risk in your portfolios going forward. If you're a guest here and you'd like to visit with me, you should have a blue card that they gave you. Just fill that out and say you'd like to meet with John. I'll visit with you to answer any questions that you have. Our business really, there's three things we manage: investment risk, taxation risk, and distribution risk. To that end, next month, I'm going to have a pertinent conversation with y'all here about tax planning. So there's, not because of what might happen tax rules with taxes, but nonetheless, I think we probably will get a little tax break this year. And whether we do or not, I'm going to show you what some of you might want to do to keep more of what's already yours. Because when you get to be 70 and a half and you have to take out that RMD, you have a lot less options with that. And that'll be in next month's Speakers Bureau. And then probably for June, there's a doctor that spoke for us about 5 years ago. Who remembers Emma Kruger? Anybody remember Emma Kruger? It was one of our more highly received presentations we had. I don't know why we saw them to get her back in here, but she's really focused on better living. Not living longer necessarily, but better living. And I'm talking to her about coming in June or July, so we'll probably have her. May have to wait till July because Terry Gage is also on our radar, which is our Social Security Medicare expert. So it'll be tax planning, Emma Kruger, and then Terry Gage with the next three Speakers Bureaus. If you're a guest, I strongly encourage you, if what you saw here was interesting to you, or if you didn't understand any of it, or if it made you think, man, maybe should I know more, by all means, register for a consultation with me and I'll visit with you at that point in time. I think Leanne has some refreshments over